I'm Russell Cummings, and I want to just take you through some simple financial management models that I use to determine the levers we need to pull in business in order to drive change around profitability, increasing sales, those sorts of things. Now, there's no substitute for having the skills and knowledge to understand balance sheets and profit and loss. And I find that too many people in business and on sitting on boards don't really understand a profit and loss or a balance sheet and how to analyze them. Now, we could spend 2 days going through that, and I don't intend to do that now. But what I'd encourage you to do is go off and get some training and some skills improvement in your areas around balance sheets and profit and loss. But we're not going to discuss those today. What I do want to talk about, though, is some models that are around the right sort of levers that you could pull. This is a really simple model, and I like it because it's really simple. 2 axes, unit sales down the bottom, so the number of units we've sold, and money up the y-axis. Okay. Now, the model basically says for any level of sales, we have some fixed overheads, right? So basically, our overheads or our fixed costs in our business are flat. Now, I know and you know that they're not flat for the long term, and they're only flat for a short period of time, because you can't just put on part of a machine or a part of a person or whatever. I suppose you can through casual labour, but you can't add different things to your business in incremental chunks. So if you're going to step up your overheads, they normally step up at a certain point. Okay, but over the short run, they're normally flat. The other line you can see there, the grey line, is the variable cost or direct cost line. And basically it says for every unit that you produce, you're going to have a variable cost, and that will add to your variable costs. And if we set our variable costs on top of our overhead line, the grey line then becomes our total cost. So that's the total cost of producing that volume of product. Now the orange line is then sales, and it basically says for every time we sell a product, then we actually incur some sales, and at the point where the sales line crosses with our variable cost or total cost line is our break-even point. It's often called the golden box or the golden ton or the golden hour or whatever in our business. Okay, but it's the point at where we break even, where we start to make a profit. And you need to understand the break-even points in your business in terms of the number of sales and the amount of revenue you need to generate in order to break even. All right, so that's our model. So anything above the break-even, so to the right of the break-even point, under the sales line and above the grey line is profit. So the area covered in there. So you can see that as we move further out along the unit sales line, that we make more and more profit. Now, what can we do to change things? Well, there are only 4 things we can do. There are only 4 levers that we can pull. So the first lever that we can pull is to increase our sales, all right? So to lift our prices effectively is what we're talking about here. So to increase our sales, we need to lift our price. So that's the one thing we can do. So we can increase our sales price. We could decrease our variable costs. So if we decrease our variable costs, then what we're actually doing is increasing our gross margin or our gross profit. So we could decrease our variable cost by changing the slope of that line effectively and creating a bigger area between the sales and the variable cost line. This also reduces our total cost. The other thing we can do is actually reduce our overheads, and that slides our total cost line down by the amount of savings, increasing the area between sales and total cost line again, which then increases the amount of profit we make. And the fourth thing, and the only other thing we can do, is to sell more product, so more units, so sell more units at the same cost structure and sales structure. Okay, so if our sales pricing doesn't change and our costs don't change and we sell more, we simply make more. Okay, so they're the only 4 things you can do. Increase sales, increase price effectively is what we're talking about there, decrease direct costs, reduce overheads, or sell more units for the same cost. So the question is, what levers are you going to pull to increase profitability in your business? Now, what I find is too many businesses focus on cutting costs and not on the increasing, not on options 1 and 4. So how can we increase sales or sell more units? So increase our volume of sales, if you like. So price and volume are the 2 things we think about. So let's talk about what we can do to actually increase sales. And this is a really simple model that I like to use. And the model says sales is about 3 components: the number of customers we have, the average sale per transaction with those customers, and then the number of transactions per customer per year or month or whatever period that we're looking at. So basically it says if we have 100 customers, that every time they come into our shop they spend $100 with us, and they come into our shop 10 times per annum, then we will have a business that turns over 100 by 100 by 10, or $100,000 per annum. Now that's quite a simple model, because then we can start to work out, and you can do this, in pairs with other people or whatever, we can then start to work out what are the things you can do to increase your customer numbers. Now, the big failing is lots of businesses don't need more customers. Okay, I've gone to too many businesses where I find that their focus is on outbound marketing, trying to attract new customers into their business, and they've got thousands of customers that they don't service and they don't communicate with regularly, so the transactions per customer are really low. So the focus for your business may not be on more customers. It may be about saying, how can we increase the average sale per transaction? One way to do that is to sell them more, so increase the volume, or to increase the price. Okay, and there are a couple of ways of looking at those things. We can also package things together, so we could look at value adding. So there might be some way of value adding. If we're in a horticultural or agricultural position, we may be able to value add and create new products. We may be able to package a product and a service together and sell it for a higher price. We may be able to bundle together and give them an option. You buy 2 of these and you get a discount on buying product Y for a certain thing. So there's lots of options we can do to try and increase the average sale per transaction. And they often fall into 2 areas. One we call upselling, and I want to use fast food, say McDonald's is a great example here of this. Upselling is where they say, can I upsize you here? So can I sell you more product? So for an extra $1, you get more fries or more drinks or whatever it is that you're buying. So you upsize your meal. So what they've done there is increase the average sale. The other thing they can do is cross-sell. So cross-sell another product. Okay. So the great example here from McDonald's again, thank you very much McDonald's, is do you want fries with that? Now my understanding is it contributes significantly. I've heard figures of 30% increase in the level of fries that they sell, which is fantastic. Okay, so what they're doing is cross-selling you there, and the good organisations now have systems in place, like McDonald's and others, have systems in place where if you've already bought some fries, they ask you, do you want a drink with that or a dessert with that or whatever. So they're trying to upsell and cross-sell you into other things. All about lifting the average sale per transaction. Sometimes they might even take a slightly lower margin on a bigger slice of the pie. And then the other thing is you can think about is, how can I get people to buy of us more frequently? Okay, so transactions per customer, how can I buy off them? And if they only buy off you once a year, how could you get them to buy off you twice a year? How could you, if you're a carpet cleaner and they only get their carpets cleaned once every 2 years, how could you get them to clean their carpet once every year? So what systems can we put in place there? Great service is one of the ways you get people to come back, but can we also give them loyalty bonuses and a whole heap of other things that encourage them to come back? Or we build marketing programs around contacting them more frequently so they come back into our business. Whatever it is, think of these 3 things. So these are 3 levers you can pull in your business. You can brainstorm with your team around these in terms of how do we increase sales. Okay. So some simple financial models. Okay, the first one is really the profit model, and there are only 4 things you can do to increase profit. And the second one is, think about increasing sales. It's really hard to cut costs in your business, and what can you do to lift the level of sales in your business? And there are 3 levers you can pull there, and we talked about those. Got any questions, just plug them into the system, into the area below. I'm happy to answer any questions you may have, and I'll talk to you again soon. Thank you.